Today, I'm going to show you the top 5 ETFs that are more profitable than the S&P 500, backed by historical results. Then, I will also walk you through how to combine them in a fully automated free investment plan that runs on autopilot, so you can grow your money in a simple, easy and efficient way. I'm ATP and let's get started. Firstly, I want to thank XTB for supporting this video. XTB offers 0% commission on real stocks and ETFs, with a minimum transaction value of just €10. These conditions apply up to €100,000 in monthly volume, and above that, there is just a 0.2% fee. If you are new to the platform, check the full tutorial linked in the description. Also, if you open a new account using the code ATP, I will give you 1 month of free access to our premium investing group. There, I share my full portfolio, trade alerts, ETF strategies and much more. Just sign up, send us a screenshot and you are in. For those who might not know, an ETF or exchange traded fund is a type of investment that lets you buy a diversified portfolio of assets, such as stocks, bonds or commodities, all in a single trade. This makes them easy to access, highly liquid and cost efficient. They offer instant diversification, help reduce the risk and give you consistent profits. And the best part, with XTB, you can buy them every month with 0% commissions. The most popular one is the S&P 500, which combines the 500 largest traded companies in the US. It includes global stocks like Apple, Microsoft, Amazon and Google, and it's often considered the benchmark for the overall stock market. For example, if you had invested in an S&P 500 ETF 30 years ago and held on, you would have achieved an average annual profit of 10.83%, even through financial crises and market crashes. But here's the thing, while the S&P 500 is a strong performer, it only gives you exposure to one country, the US. So there are other ETFs that go beyond, covering global markets, different sectors and even specific investment styles. And some of them have actually delivered higher returns with lower risk. And so, in this video, I will show you the top 5, and all of them can be found on XTB. Let's start with the easier to understand, the iShares Score S&P 500 with the ticker SXRT. Basically, this ETF tracks the performance of the S&P 500 index, but here's the key advantage. Unlike some US ETFs that pay dividends in cash, this one is accumulating, which means that all dividends are automatically reinvested. This helps your money grow faster through compounding, especially over the long term. The total expense ratio, which represents the annual cost of managing the fund, is just 0.07%, which is extremely low, especially when compared to the average fund, which usually charges between 0.3 and 1%. If we go to the Risk and Return tab, we can see some other metrics. Next to it, the ETF risks, and finally some of its holdings. So this will be the first ETF in our automated investment plan. To add it, simply go to the Investment Plans tab on your XStation 5. It's right next to the Market Watch. Click on Create New and then search for SXR8 and select it. Over the past 5 years, it returned close to 100%, with a risk score of 4, which is medium, and a 5-star ranking. So, as you can see, it will be a major ETF on our investment plan. Now, back to our market watch, let's look for the second ETF in our list. It's the S&P 500 Information Technology sector, with the ticker QDVE. This ETF is a bit more selective. Instead of tracking all 500 companies in the S&P 500, it focuses only on the technology sector, including divisions like hardware, AI, cloud computing, cybersecurity and much more. So you are getting exposure to the fastest growing segment of the US economy. Just like the previous one, QDVE is also accumulating. Then it has a slightly higher expense ratio of 0.15%, but it is still well below average and justified considering its more focused strategy. If we check the risk and return section, we can see this ETF has higher potential returns, but also comes with a beta slightly above 1, meaning it's a bit more volatile than the broader market. Still, it's one of the top performing ETFs available. Going back to our investment plan, let's add the QDVE. Over the past 5 years, it returned an impressive 156% with a risk score of 5, which is still manageable for long-term investors. And just like the previous one, it also holds a 5-star rating on XTB, showing strong diversification within the tech space. This will be the most aggressive ETF in our portfolio, the one with the highest return but also the highest volatility. That's why it's important to combine it with more stable ETFs, like the next one we'll cover, which is called Core MSCI World, with the ticker EUNL. This ETF gives you exposure to over 1,600 companies from 23 developed countries around the world, including the US, Europe, Japan, Australia, and more. It's one of the most diversified global ETFs available and a great foundation for any long-term investor. The expense ratio is just 0.20%, and like the others, it's accumulating. Going back to our investment plan, if we check its historical performance, EUNL has delivered a solid 84.17% return over the past 5 years, with a medium risk score, and it also holds a 5-star rating on XTB. Because of its wide diversification across different sectors and countries, it tends to be more stable during periods of volatility or market corrections. So at this point, we already have solid exposure to the US market and also to the global economy, and that's why our fourth ETF will now give us more exposure to the European zone. It's called the Core Euro, with the ticker SXRT. This ETF gives you access to the 50 largest and most important companies in the Eurozone, offering a strong and diversified outline of the European economy. It's also accumulating, and the expense ratio is just 0.10%, which is excellent considering the coverage it provides. On the holding tab, you can see some of its holdings, which are well diversified across different sectors. So let's go back to our investment plan and search for the SXRT. We can see that, even though it's less volatile, it still delivered a solid 83% return over the past 5 years. It has a risk score of 4, and just like the others, it also holds a 5-star rating. So it clearly deserves a place in our long-term investment plan. Now we are just missing one more ETF to complete the portfolio. At this point, there are a few good options. For example, we could go with the DAX ETF, which tracks the 30 largest listed companies in Germany. It has returned 81% in the last 5 years, comes with a risk score of 5 and also holds a 5-star rating. Another option will be the iShares World Momentum ETF, with the ticker IS3R. This one includes global stocks with the highest momentum, meaning it selects companies that have shown strong recent performance and are expected to keep trending upward. Over the past 5 years, it returned 78% with a risk score of 4 and again a 5-star rating. However, in my case, I want to make sure this portfolio gives me exposure to all types of markets, and that's why I will go with a different option, the Emerging Markets ETF, with the ticker IS3N. This ETF includes over 1,400 companies from emerging economies like China, India, Brazil, and others. These are fast-growing markets with huge long-term potential. On XTB, it has an expense ratio of 0.18%, and it's also accumulating. When we add it to our investment plan, we can see that over the last 5 years, it returned 34.53%. It comes with a risk score of 4 and a 4-star rating. It's slightly less popular than the others, but it plays a key role in this portfolio by adding exposure to fast-growing economies that are often underrepresented in traditional ETFs. So now that we have added all 5 ETFs, let's adjust the percentage division to create a balanced plan. Here's what I recommend: 30% on the S&P 500 core, 20% on the tech sector, 25% on the world ETF, 20% on the Eurozone, and 5% on the emerging markets. And now here's the really exciting part. If we look at the performance of this diversified portfolio over the past 5 years, it delivered a total profit of around 100%, which is an average of 20% per year. To put this in perspective, if we look at the performance of the S&P 500 alone, it returned 82.4% in the same 5-year period. Also, the max drawdown of the S&P 500 in the same 5 years was around 26.8%, while this diversified plan had a max drawdown of just 19.2%. That means this strategy doesn't just give you higher returns, it also protects your capital more efficiently during market drops. Now, all you have to do is click on Next and give your plan a name, for example, My Investment Plan. Then, by clicking the Top Up Funds button, you can choose the Auto Invest option. From there, just select your payment method, either using available funds or via bank transfer. In this case, the minimum monthly investment for this portfolio is just 21 euros. Once you confirm, the platform will automatically split your monthly investment across the 5 ETFs and reinvest everything for you, so you don't need to do anything else. It's truly one of the simplest, smartest and most effective ways to create long-term wealth, without stress or complexity. And that's it. If you enjoyed this video, don't forget to hit the like button, subscribe for more content like this, and share it with a friend who's starting their investment journey. I'm ETP, thanks for watching, and I will see you in the next one. Bye bye.